Okay, thanks to each of our leadoff presenters. Each of them, quite appropriately, mentioned the financial crisis, and Mike dwelled on that to some extent and mentioned the comparison with what happened in the 1980s with the S&L crisis, and particularly highlighted the accounting issue, which turns out to be of critical importance. We have somebody with us today who, in addition to running one of the most successful real estate investment firms in the country or the world, was in the middle of the 1980s S&L crisis, and particularly the policy response to it, literally managing a number of the workouts from that situation. That's Joe Robert, who runs, of course, the JER company here in Washington. It's a global company with major real estate financial interests around the world. He's a member of our board of directors, our executive committee, and I would be missing a big opportunity if I did not ask him to give us a few words to lead off the discussion by telling us what he thinks the perspective on the current financial crisis is and what ought to be done to make sure we get out of it. Joe, why don't you come up to the mic and just say a few words.
It's up to you.
Well, Fred gave me all of 60 seconds to prepare by asking me at the table, do you mind saying a few words? Mike was right when he said that the entire S&L banking industry was underwater in 1981. And of course, we had high inflation, and I think the prime interest rate rose up to close to 20% or so. But the way the Feds dealt with the problem then, hide the pea under the shell, hide the loss under the shell, I think in many respects, while it may have laid the seeds and the foundation for problems later on, the problems were very different later on, and I think could have been prevented with different kind of regulation. The problems and why the S&L industry and the banking industry was insolvent back then was largely due to spread problems. And unfortunately, the regulators took the cap off of what you could pay for deposits, but did not remove the ceiling in the S&L industry for where you could put your money in terms of assets. So obviously, if you were taking in deposits at 10 and lending the money out at 8, even my seven-year-old second grader could do the math on that and say, how do these guys stay in business? But if you study financial history, and I've got an honorary degree, and that's it, and these gentlemen have a PhD, so I'm not going to pretend to be an economist, but if you look back over the last 100 years at financial crises around the world and how they got solved, the first was to bring back liquidity into the system. And this is a common theme with every country that went through a crisis. First was to get liquidity back into the system, and it seems to me we're at a point where the Fed's pumping liquidity into the system, but nobody knows. The banks can't lend to each other because they don't know what their balance sheets look like. They don't have any idea what the worth is when you have illiquid securities on your books, and you've got this mark-to-market accounting rule that came into effect, I guess, after Enron. And the example I would use is, in this, you could extrapolate from this across the entire banking and securities industry, or any industry that holds securities. Is that if I asked you how much your house was worth, and let's say you said it was $1 million, you'd probably list it with a realtor. Maybe you'd sell it in 3 to 6 months. Maybe you'd have to knock off 10%, take a haircut. But if I stuck a gun to your head and I said, you're dead, you're finished, your heart stops if it's not off your books and out of your name and the deed transferred by tomorrow at 5 o'clock. Well, you wouldn't get $1 million and you wouldn't get $800,000. You might get $200,000. You might get $300,000 for it if you found a buyer at all. Well, that's what's happened here. You've got institutions that have securities, debt securities, that are performing, and I don't mean just in the residential side. You've got debt securities that are performing, that are cash flowing, that have very low delinquency rates. But because they're in 10-year bonds, and you never intended to sell them in the first place, they have to be marked to market. And the new mark, is that neighbor of yours down the street who had the gun to their head. So if you take from that, you say, okay, that's what all the houses now in the neighborhood are worth, is $200,000. And that difference, that $800,000, eats into the equity of the banks across the nation, which means what? It means they have less money to spend and more losses, and we're living in a situation where perception is far more important than the reality. The reality of these losses is going to be borne out over time. The perception is based on that mark from that neighbor who had the gun to their house and had to sell the house. Of course, I'm not talking about houses. I'm talking about an institution that because of these marks has to deleverage, pay the debt down, and suddenly sell off performing assets at a huge discount because of an illiquid market. So you asked me to talk about what they're doing. I said the second thing is the accounting issue. And I think if they do not find a way to go back to some form of regulatory forbearance, but this time, instead of doing what they did the last time, which is allow the private market to recapitalize these institutions to make huge sums of money with government assistance, that if there is government assistance, then the taxpayers ought to get that money, or at least participate it, but at the same time give private capital an incentive to participate. The comparisons between the new bill and this vehicle with the RTC it's a very different vehicle. It isn't the RTC. The RTC never bought any assets from anybody. The only assets the RTC ever bought were the typewriters and the telephones and the desks that were in their offices. They were a trust that held receivership assets that were coming off the failed banks, failed savings and loans in the country. This is a situation where the government is actually going to buy assets. Who are they going to buy them from? How are they going to price? I don't think there's enough talent in the country that has the skills, or not enough people have the skills to peel away each layer of those onions of these complicated securities and understand what they're worth. But they are worth something. The skills are out there. So it's going to be interesting to see how this unfolds. And then the third thing, of course, is until the markets believe that they've exhausted themselves on the downside, you're not going to see capital come back in either into the home building industry or on the commercial side either.
Okay, Joe, thank you for those slightly disturbing. Okay, floor is open for questions, comments. Bob Samuelson. Just get up close to the mic, Bob.
I'm doing my best, Fred.
Thanks.
Okay.
You're doing better now.
Okay, thanks. Mike, in your forecast, you don't have all that much in the way of an effect of a fallout from this financial crisis. And so I have a two-part question. One, can you talk about what you think the consequences would be if we don't pass some sort of a rescue? And you talked about the money market being really at the vortex of financing for everyday operations of American business. And secondly, you seem to discount any kind of international contagion. That is, either financial institutions in other countries having problems, or, as Arvind suggested, some sort of a secondary effect because some financing in other countries came from American institutions that now may be weakened. Can you comment on that?
Well, if we're not able to calm down the disruption of short-term credit markets reasonably promptly, then I think we're looking at a pretty severe recession that will begin fairly promptly in the fourth quarter. We're almost at the end of the third quarter now, and it doesn't take very long if businesses can't roll over a lot of their short-term debt for them to begin asking, well, where can we cut back on the drain of cash in order to avoid going into bankruptcy? So I think the effect will be very substantial and quite rapid. Now, I'm not anticipating the Great Depression again. That was an episode in which real GDP fell 33%. But it's going to be hairy for a while. Now, I think also what will happen is if that begins to look like the path down which we are walking, we will have a bailout the scale of which is unbelievable. I mean, we're talking about a mere $700 billion, and I think you'll probably add a zero to that figure if it's thought to be necessary if the economy is going into a very steep downturn. Now, I think if that is happening, the problem is going to be significantly broader than just mortgage-based paper. So they're going to need to find an alternative way of doing it, which will probably involve injecting capital directly into financial institutions and then taking back claims which provide at least some hope that the taxpayer will recover something at some point. But I don't believe that the government would just sit still and watch things go down the tubes. Let me say, in 10 years at the IMF, I had a lot of experience with financial crises. And believe me, governments all around the world go for bailouts. They get stuck traditionally when the problem is that they have to bail people out of their foreign currency debts, and they don't have any foreign currency. Well, the United States is really not significantly in that predicament. So if it's a matter of printing dollars, we've got our own printing press, and I believe we would use it. Now, what about the impact on the rest of the world? There are two channels. One is the financial market channel, where disruption of short-term credit markets in the United States. We've already seen that that's spread to the European markets, which trade dollar-based assets. So European financial institutions, to the extent that they have to roll over dollar liabilities, of which they have substantial amounts, right? Well, they can't go to the Fed directly, so they go to the Eurodollar market, try and get it from American banks that won't lend it to them. So we arrange official swap lines so that the Fed can lend dollars to the ECB can lend the dollars then to European banks that are under stress. We have a mere $80 billion of that outstanding. There's no reason why that can't be made $280 billion or $380 billion. We don't think the ECB is going to go out of business, and I don't think the Federal Reserve is going to go out of business. The great virtue of being a central bank, of course, is that your principal liability currency, you don't have to pay any interest on it. So long as people aren't running out of currency, it's hard for a central bank to go insolvent. But there would be significant international spillovers through the financial channel. And of course, as Arvind mentioned, through the real channel, if the U.S. economy goes into a steep recession, exports to the U.S. are going to take a sharp downturn. So it will spread through both of those mechanisms. One senses in the political debate that there's a kind of unreality in the minds of some people who I think don't understand how serious are the consequences of the type of disruption that we are on the edge of, if not in the middle of, in terms of the functioning of the short-term credit markets. But I think if they don't do something fairly convincing, that we're rapidly going to find out.
Okay, Colin?
Colin Bradford from Brookings. I mean, one way to describe how we got into this mess is to say that there has been regulatory and oversight abdication. And I just wonder whether any of you could paint a picture about how to redefine the relationship between the U.S. government and financial markets in terms of regulatory regime and oversight regime, supervisory regimes, which would change the dynamics so that this kind of laissez-faire market excess doesn't get out of hand the next time around.
I might just mention that one of our other senior fellows, Morris Goldstein, is actually developing a comprehensive response to that question. We'll be unveiling it here on October 7th, luncheon meeting. Most of you will be invited to that. He's already published an early version of it, one piece of which, the idea of a liquidity pool among the banks themselves, has already been adopted as part of the policy response to date. But in Morris's absence, I'll ask Mike to fill in.
Well, fundamentally, I think we need to recognize that this problem will never be solved. We can lessen the likelihood of its occurrence, the frequency of its occurrence, and the possible damage that it might create. But we've had financial crises repeatedly in this country throughout our history and around the world. And we're not going to make them go away with any regulatory system. Part of the reason for that is the way in which the private sector behaves. I mean, we do have a kind of manic depressive behavior in asset markets. And I mean, we had the dot-com bubble there. I mean, people sprinkled fairy dust on a group of enterprises and said, you know, there's a great future for all of this, and the market just pushed the values up in the air. What I always said was the problem in the dot-com crisis was that they didn't understand that what comes after the decimal point really isn't worth anything. But when that realization began to dawn, then you had a crash in those stock values. Some of the escalation of real estate prices that we saw in the United States, I think we could say, well, the Fed, in the clear light of hindsight, kept interest rates too low for too long, and that helped feed the housing boom. Right? But it didn't make prices in Las Vegas do what they did, or prices in Florida. It added something to the overall rise of home prices. And if the Fed had tightened more aggressively somewhat earlier, we would have had less of it. Similarly, in the subprime market, if the regulation had been more thoughtful, we would have had, I think, less of the shenanigans that were going on, and we would have less of a problem. But I think to believe that we somehow would have avoided substantial escalation of home values is a mistake. Now, in terms of the financial market reaction, I mean, one of the peculiarities of the financial markets is that actually Barack Obama was wrong when he said a pig with lipstick is still a pig, right? That the fact of the matter is that if you can persuade people that a pig with lipstick is substantially more valuable than a pig without lipstick, and you can price that stuff in the market, right, then for a while it's true. And I think with the CDOs and the CMOs and the CIVs, that is to an important extent what happened. They were pigs with lipstick, and the investment bankers and others managed to persuade people because they had the magic property of liquidity. That is, you could buy them and sell them without anybody asking any question as to what's really in these things. They added value to them, and the capacity to create value out of nothing is an extremely powerful incentive for people to invent things. Well, when I talk at the Adam Smith lecture, I mean, this was a problem that did very much concern Adam Smith. And while his monetary economics are a little bit kooky, in that he was a strong advocate of the real bills doctrine, that the problem that concerned him is a real and continuing problem in the financial sector. And I believe that we're never going to solve it completely. And we have a long history in this country and elsewhere when you have important financial innovations that introduce new ways in which people can take on risk and put lipstick on pigs, then there tends to be an overexpansion for a while until people get caught as they begin to recognize these things are really not all that valuable, and then there's a correction. I don't think we've ever found a way to get away from that type of difficulty. We need to be aware that these types of problems will occur and recur and be somewhat better prepared to deal with them. As I say, I mean, I think this time it's fortunate in that the underlying U.S. economy is actually in pretty good shape. We don't have built into the system double-digit inflation. So we're not in the situation that we were in 1981, 82, where the Federal Reserve absolutely had to slam on the brakes and keep their foot down in order to disinflate the U.S. economy and reestablish its credibility. So there wasn't then the flexibility to ease monetary policy in order to deal with the problems in the financial sector. In that circumstance, I think it was a good thing that we were able to hide the problem in the financial sector until we were in better condition to deal with it some years later. I think we waited too long before we faced up to it, and we allowed too much funny business by Larry Keating, who John McCain must remember, and others that added ultimately to the taxpayers' cost. But it was, I think, useful from a broader macroeconomic standpoint that when we didn't have monetary policy that we could use to help deal with the problem, that it didn't immediately show up that all of these institutions were insolvent. This time, where I think the institutions are not basically insolvent. Not surprisingly, those institutions that are very heavily focused in mortgages, Fannie Mae, Freddie Mac, IndyMac, WAMU, well, they've taken a couple of torpedoes below the waterline, and they've been in deep difficulty. But the more diversified financial institutions for which these mortgage instruments are a relatively small part of their business, neither their balance sheets nor their basic business models are that much threatened by recent developments. The problem with WAMU is not only they have problems on their balance sheet, but they were primarily a mortgage banker, and that's not a very good business at present or for a while. And so their value as a going concern was not all that great. In contrast, I believe that the value of the going concern of large commercial banks has actually gone up because the direct credit markets for commercial paper and the rest of it are not regarded as reliable. So the banks ought to be able to do a very good on-balance sheet lending business, and they ought to be able to charge very substantial spreads, more substantial than before, because competition from the direct credit markets is much less of an issue now. So as going concerns, I think many commercial banks ought to be able to make a lot of money going forward. As I say, those that were heavily into mortgages, their balance sheets are just not in very good shape. And Fannie and Freddie, which I think were very good in managing the term structure risk, which is what really killed off the S&Ls. Fannie and Freddie were pretty good at that. But they're completely exposed to the default risk on mortgages, right? That they insure mortgages and hold them themselves, and they can't. If the problem is that mortgages go into default and your losses are 5% of the total value of the mortgages that you hold or insure, their capital is just not enough to cover that magnitude of loss.
Well, obviously the wisdom of Mike's forecast is rivaled only by the levity with which he addresses serious topics. We've reached our witching hour. I wish we had time for more, but hopefully this gives you some thoughts on where things might go. Stay tuned. We'll certainly be back at it more frequently. Thank you all for coming today.